Here.
Trustee McMahon.
Present.
I believe we have a new trustee, Chris Gordon.
Yeah, hi, good afternoon. I'm not even official yet, but I'm listening in just to learn, so hello.
Welcome.
Well, welcome, Chris. I
Thank
look
you.
forward to meeting you.
Same here.
All right. And Eamon, I think you joined us. Welcome. Um, Before I introduce the first agenda item, just want to remind everybody to leave your mics on mute when you're not speaking, and just do the little raise hand thing, and I can get you with your questions. Welcome, Matt, to the meeting, and welcome, Ryan. I think that's everybody that was expected to be on. Welcome to the May 2026 Investment Committee meeting. It's finally nice to see that summer's ahead of us, so we're all pretty excited about that. And obviously going to report on a pretty interesting first quarter, and we sit in a different position today, but who knows what tomorrow brings, right? That's why we have our consultants. We're going to transfer over to NEPC. Um, We've got Kelly and we've got Matt and we have Lauren. So without further ado, transfer it over to Kelly to introduce and talk about the capital markets review and the quarterly performance.
Thank you,
Thank you.
Trustee Martin, and good afternoon, everyone. It's good to be with you today. Um, Before I turn it over to Matt to walk through the market review, I did just want to introduce you all to Lauren. Lauren is joining the committee meeting for the first time. She has worked with Matt and myself on your account for a number of years behind the scenes. She's one of our star analysts at NAPC and wanted to bring her into committee meeting session. So she'll be reviewing the investment policy statement with you later today. So just wanted to welcome Lauren to the group and introduce all of you to her.
Welcome, Lauren.
Thanks
We
very
look
much.
forward to
Happy to be
working
here.
with you.
So with that, I'll share my screen and Matt, I'll turn it over to you to start us with the markets.
Great. Thanks, Kelly. Well, as you're pulling that up, maybe if we go to slide 3 and we can walk through how markets actually performed through March of this year. And before we do, maybe think back to last year. We really came off a really strong but volatile 2025. And some of the themes that we saw play out as we moved towards the end of that year have really come through in especially January and February. So January being, a pretty strong month, particularly for value, small cap, and non-US markets. February, some of those same, value outperforming growth, large cap underperforming small cap continued, but it was a little bit more mixed performance. And then March, sort of everything down sharply. This was the start of the Iran war. Non-US markets, which had done so well up until that point, had really started to sell off as investors flocked back to the US markets and the US dollar. This really, when we saw that happen, really reinforced our view that there really isn't an alternative to the US dollar in terms of the world's reserve currency. You may recall there was some discussion about that, a couple quarters ago. But really, we've seen that come through and reinforced our view there. On the fixed income side, towards the middle of this page, you can see sort of more broadly lower. We saw some inflation concerns come through. Fed rate cuts, which had been an almost certainty coming into the year, seemingly on hold now. And there's a slide that we'll touch on that shows that. And then we saw some slight widening of spreads there. On the bottom of the page, the real assets, unsurprisingly, the best performer of the quarter, led by oil. Gold also did pretty well despite some double-digit sell-off in March. Again, really not surprising in times of conflict here, particularly when that conflict is in the Middle East and the disruption of oil, which plays such a big role in those markets. Now, as you look at this page, and I don't think we have anything in here through April since we're still towards the beginning of this month, but April was sort of a complete reversal, and we're actually back in positive territory with the strong markets that we've seen so far, at least through April and beginning of May. So with that, maybe let's hit on a few charts so you can visualize some of these themes. And let's actually jump forward to slide 6, just to show you sort of this differential between what we saw in the first 2 months of the year and in March. You can see the dark blue line is what we saw performance from the end of the year through February, and then that lighter blue being what we saw in March, and really just a complete, reversal. And if you were to layer in, April on this, you'd see it sort of again opposite, to where we'd be back on top to what we saw really at the end of February, and maybe even a little higher at this point. On the following page, on page 7, wanted to highlight sort of this reversal of what we've seen for much of the past, 3+ years of where growth had really outperformed value. We saw a reversal of that in Q1 to the 5th largest differential between those two ever, and really just behind what we saw of Q1 of last year. Both sort of value outperforming growth, sort of in that 10 to 15% range there. So kind of a reversal of what we've seen past years, setting aside the Q1 of 2025. And then maybe 2 slides forward to hit on some of the Fed here, just to show you where markets are pricing in things today. As I mentioned, coming into the year, almost a guaranteed certainty that we were going to see Fed rate cuts coming in 2026, and that's what's reflected. You can see in that sort of middle line in each of these bars was focused on the Federal Reserve there. That was the expectation at the end of the year, 12/31. And where you see the darker blue and that lighter blue, that's kind of where we are now, where we expect Fed rate cuts to be at the end of the year, which means roughly no change, where before we were thinking sort of 2 to 3 rate cuts. So big changes there. That obviously sort of permeates through the markets, both equity and fixed income. So it'll be interesting to see how that plays out, particularly with a new Fed chair coming on board here shortly. And then maybe one final graph I want to highlight on page 14, just to show you some of the impact that the Iran war has had on oil, and maybe how that impacts the rest of the world more so than it does with the US, sort of underscoring the themes that we've seen investors really come back to US markets. The oil disruption that we've seen, really sort of the US is a little bit more insulated to that. It helps to be a net exporter there. And a lot of the oil that comes out of the Strait of Hormuz is going to markets like China, Southeast Asia, and to a lesser degree Europe, and to a much lesser degree the United States. So while it is sort of a global impact, there are some markets that are going to be a little bit more impacted than the US markets, which is part of the reason we saw those markets sell off in March, and US markets really rally relative to others. With that, maybe let's shift to the next page, and I'll end here, which is just our outlook as of April here. Given the volatility that we've seen last year and seen thus far this year, we don't see that going away. I think this really just represents opportunities to rebalance, and we're continuing to have our clients out on the lookout for rebalancing opportunities should we see volatility continue. And we want to ensure that there's adequate exposure to value and quality, which tend to perform well when market breadth expands, which is what we've seen in Q1, and what we would like to see, or sort of expect to see go forward. That helps active managers in particular in your portfolio. On the fixed income side, advising clients to really lean more into the safe haven type fixed income over more high yield, where spreads are still low, but they have widened out a little bit, and market sentiment has sort of turned there, which can spell trouble for our high yield markets, particularly in the lower quality markets there. And then to the extent that there's any real assets exposure within portfolios, we're advising clients to take a look at those, make sure they're in line with your long-term targets, potentially rebalance away from those given the run-up. Within your portfolios here, you're getting more of that exposure in some of your active managers like Newton and PIMCO, which have done well. And they're actively sort of managing those. So maybe not anything specific to your portfolios in terms of recommendation there, but something that would see going forward in terms of the performance coming out of those managers. With that, maybe I'll end and pause to see if there's any questions on markets before we shift to the portfolios.
Any questions from the committee? Go ahead, Matt.
Great. Well then, Kelly, maybe do you want to take us through portfolios?
Absolutely. Thanks, Matt. So I'm going to start with just an overall summary of each portfolio, and then I'll dive into manager due diligence announcements and then actual performance of the managers. But starting here with the operating fund, we had assets increase by 34 million during the first quarter. We had positive performance, but also asset inflows into the operating fund. So you can see we ended the quarter at about 263 million. When we look at the pie chart and the asset allocation, the three different buckets are within policy ranges, but we have drifted a little bit away from targets. You can see that the liquidity pool here is 37% and the target is 30%. So today we're not recommending any rebalancing. Through conversations, we understand that cash will be needed for an upcoming building purchase. So we are going to revisit asset allocation with Tracy in the month of June to determine if any rebalancing needs to be done prior to fiscal year end to ensure that we're within policy ranges and closer to targets once there's more certainty of cash needs. In terms of performance in the top right here, you can see it was positive 40 basis points. Again, most of this portfolio is in cash, almost 40%. So that, helped in a very difficult market environment. And then in terms of the fiscal year to date performance, so that's basically the 9 months of the year. You can see that the portfolio is up 4.5%, which is above the 4% return target, and that managers are adding about 40 basis points of value. So this portfolio continues to do well. Long-term numbers are strong, outperforming that 4% target return, and managers are in line or adding value depending on the trailing time period that you're looking at. I did a quick estimate for April, estimating that returns would be strong for this portfolio, estimating it would be up about 2%. So that would bring your fiscal year to date number through the end of April to about 6.5% or so. We have no recommendations for the operating fund at this meeting. There's no manager due diligence updates for this portfolio. And as I mentioned, we'll continue to work through potential rebalancing with Tracy and her team towards the end of June if needed. Moving on to the pension fund, we had assets decrease by $1 million in the first quarter. We ended the quarter just shy of 15 million, as you can see above the pie chart here. Most of that $1 million decline, $700,000 of that was due to benefit payments, and the other $300,000 was due to the market decline that we saw. In terms of the asset allocation, this portfolio continues to be within ranges and close to targets. We do rebalance at a minimum on a quarterly basis, sometimes every couple months, to raise cash for those benefit payments. So that's a good source for us to continue to make sure that this portfolio is staying close to those long-term strategic targets approved by the committee. In terms of performance, you can see that the portfolio was down about 1.8% negative for the quarter. Performance continues to struggle. Just looking at the composite versus the allocation index for the quarter, you can see that managers detracted 70 basis points. And almost all of this, as well as the long-term performance numbers here, is due to global equity active manager underperformance. And we'll talk a little bit about that in a moment. Additionally, during the quarter, we did see some underperformance from managers that are focused more on the lower quality credit. Managers that have done well but did struggle as spreads widened out. In terms of April estimated performance, estimating a good month for the portfolio up 4%. So fiscal year to date up almost 5% through April. We have no recommendations for the pension fund today. There are two manager due diligence announcements that I'll talk about in a moment. And then just a recent update is, if you recall, at the last investment committee meeting, the committee approved to terminate Walter Scott and fund a passive fossil fuel-free global equity ETF, and that was funded in March. For the managed investment pool, a much larger pool compared to the pension assets, ended the quarter at 400 million. This was a decrease of about 12 million in the first quarter. We did see about $2 million of endowment distributions early in the quarter, and then about $10 million of investment losses due to the March market decline. In terms of the asset allocation is in line with the previously approved asset allocation. If you remember, a new asset allocation was approved at the last investment committee meeting. That transition to the new asset allocation occurred in April. So what you're seeing here in the pie chart is current. And when I say it's in line with policy ranges and policy targets, that is the old asset allocation because everything was implemented in April. In terms of performance, you can see performance down about 2.4%, much more decline compared to the pension fund, as this is a more aggressive portfolio, has more equities than the pension fund. However, the manager detraction was a little bit less compared to the pension fund. So you can see 40 basis points of manager detraction during the quarter. Global equity managers did contribute the most to this, as well as some of those credit managers that I mentioned, so similar to the pension. On the positive side here, we do have some active managers in the small cap space, and emerging market equity space, as well as some of the alternative type strategies that were adding value that kind of brought in that detraction during the quarter. Trustee Bradley, I see there's a question.
Yeah, sorry and I should probably know the answer to this, but I don't. When we're talking about benchmarking against these indices, could you just really briefly remind us, me specifically, what the difference between the allocation and policy index
Absolutely.
is, first off, and secondly, given some of the restrictions that that you guys have and where you invest them, are those restrictions available to be represented in any of these indexes that we benchmark against?
Sure, that's a great question. So let's start with the policy index first. So the policy index, think about that as all the targets to each asset class that has been approved by the committee. So the strategic long-term asset allocation. For example, in this policy index, you have, a long-term target to S&P 500, large cap equities, about 15%. So we apply the 15% to the return of the S&P 500 for that month, and do so for each other asset class. International equities, MSCI EAFE is used, all the benchmarks that are stated in your investment policy statement. The allocation index is, from month to month and through sometimes, raising cash for distributions, having a little bit more cash than needed, or overweighting or underweighting an asset class based on a tactical view. That's your allocation index, where it takes the ending weights of the previous month. So if we're looking at a 1-month return for March, it would take the ending weights that you actually were invested in for each of those asset classes at the end of February, multiplying it by those same passive benchmarks that are included in your policy index. So the difference there shows if any of those deviations from targets added value or detracted value. So for this particular quarter, 30 basis points of value was detracted because of any of those decisions. And then when you look at the composite versus the allocation index, that's where you kind of get the manager value add component of the equation.
That's great. Yeah. And I'm assuming the indexes don't make adjustments for like a lack of fossil fuel exposure and that type of thing, which could be a clue as to when we're looking at especially the shorter term divergences.
No, thanks for reminding me that you brought that up. So it's a great question. So for example, the policy and the allocation index for your large cap exposure is using the S&P 500, but your composite is using the S&P 500 fossil fuel free. And so for this particular quarter, that S&P 500 fossil fuel free strategy underperformed by 1%. And so that does take into account manager underperformance, even though that strategy was in line with their stated benchmark of the fossil fuel free index. It underperformed your strategic long-term targets, which are technically not fossil fuel free. Just staying on performance for a moment, just want to talk about rankings. So for this quarter, rankings fell short because of two factors. One is that we had private equity outperform during the quarter. It was positive due to its lagged nature, whereas public equities declined. The median peer holds about 10% in private equities, and the managed investment pool does not have an allocation to that. So that is a detractor. That being said, when we rank your policy index, just straight passive target return of 1.7%, that ranked in the 77th percentile. So that kind of shows, the where you're, not having the private equity, kind of where that puts you. And then on top of that, you ended out in the 92nd percentile. And so that difference there was the added difference of underperforming managers during the quarter. So longer term results are more due to the private equity lack of exposure. More nearer term results have actually been due to active manager underperformance because private equity actually has been lagging public markets up until this quarter. On a positive note, April numbers should be strong. My estimates on benchmarks are the portfolio should be up 6.5% in the month of April, bringing that fiscal year-to-date return to about 9% or so. We do have one recommendation today, which is to update the investment policy statement, which Lauren will walk through. That is just to codify the approved asset allocation by the committee at the last meeting. And then we have two manager updates that I'll discuss in a moment. Also, as a reminder, in the pension, I mentioned that Walter Scott was terminated, replaced by that passive ETF. In the managed investment pool, it was also approved to terminate Walter Scott, and that transition happened and was completed in April. And as a reminder, those Walter Scott assets were being redistributed through large cap, small cap, international, and emerging market equity. And so that was completed in April, but you won't see that in the performance that I show you today. In terms of manager announcements, so we have two manager announcements, two managers that also have been struggling with performance. The first one is Impax, your global equity manager in the pension and the managed investment pool. We have placed them on hold. Hold is one step below watch. So we start with an announcement as no action. It's just for your information. A little bit more concerning would be a watch status, and then a little bit more concerning would be a hold status. What is happening at Impax is there are three portfolio managers, three co-portfolio managers. Two are leaving. One is going on a sabbatical, so not technically leaving completely, but leaving for a period of time. And the other portfolio manager is leaving Impax overall. So that remains one current portfolio manager. And so Impax has announced that they're going to add two new co-portfolio managers to the one portfolio manager remaining. One of these portfolio managers has been at Impax since 2015. The other is a little bit more newer, since 2023. Both of these portfolio managers also serve as co-portfolio managers on other sustainable impact strategies that have a similar environmental approach as the strategy that you are in today. And the change is being communicated to us by Impax that they're trying to align these three strategies in terms of portfolio management. And overall, we think that could be efficient, but because of so many changes, we thought it was appropriate to watch the strategy more closely and place them on hold. Lindsell Train was placed on watch. This is mostly due to poor performance. The trailing 1, 3, 5, 10-year numbers are all below benchmarks. A lot of that has come from the past 3 calendar years where Lindsell Train has underperformed. Not surprisingly, kind of in 23 and 24 when growth was doing well, Lindsell Train's a more value buy and hold approach that underperformed. And then I'll talk a little bit more about in a moment, but not having energy and things of that nature really impacted them more recently. So we placed them on hold due to performance, but also because they've had performance struggles, they've seen about 15% of their assets go out the door. What that means in dollar terms, that's about $2.3 billion of investors' money leaving the Lindsell Train strategy. That seems like a very large amount, and it is, but to put it into context, the strategy still sits at about $7.5 billion today. So there's still sizable assets under management, but it is a concerning outflow that deserves to be watched. What we're going to do about this going forward. So at the last meeting, we discussed the global equity allocation. We made the decision to terminate Walter Scott. They had been in the portfolio for 5 years. We acknowledged the performance struggles of Impacts in Lindsell Train at that last meeting, but they'd only been in the portfolio for a little over a year. So our recommendation at that time was to give the managers a little bit more time, allow them to invest during a longer market cycle, 3 to 5 years. However, given these due diligence updates and some of the concerns around that, Matt, Lauren, and I are going to complete another analysis and come back to the committee at the next meeting with our thoughts and our recommendations on if a decision should be made or made recommended to you all to do something about Impacts in Lindsell Train. Just a couple other notes about them. Just as a reminder, these 2 managers were placed in the portfolio to fulfill the divestment goals. Both are fossil fuel free. That was 1. But 2, also because global equity from NEPC's standpoint was an area where we thought managers could add alpha. And in a market where it has been so concentrated across the globe in a number of stocks, some of the global equity managers have been underperforming. And more significantly, managers such as these 2 that have a sustainable and quality focus have struggled even more. They're underweight some of the best performing sectors, such as energy and defense. We've seen renewable and transition themes being under pressure more recently, and just quality overall has lagged because of that concentrated benchmark, concentrated names in the benchmark. So there's a lot going on in this global equity space, and so we're going to take a fresh look at that and come back to the committee at the next meeting with some additional thoughts. I'll stop there before I go into the manager performance and just see if there's any questions on overall portfolio performance, any of the comments I've made on these 2 managers, or any other questions that have come to mind.
Any questions? I guess hearing none, keep on
Okay,
rolling.
sounds great. Thank you, Trustee Martin. So we'll start with the managers and the managed investment pool. A lot of these overlap into the other portfolios, so it's a good starting point for us to take a look. But just to start here, at the top of the page, this SSGA Fossil Fuel Free Index, as I was speaking with Trustee Bradley, their returns down 5.3%, in line with their benchmark during the quarter, no issue. However, the decision to be fossil fuel free, if you go right above it, the S&P 500 was down 4.3. So there are going to be periods of time where that fossil fuel divestment can have negative impacts on the portfolio. However, over a long term, it would be the expectation that would even out over time. In terms of Westfield, your small cap manager here, they continue to do well. If you look at their numbers across the board, they're outperforming their benchmark over all time periods. They're ranking above median peers. When we went through the analysis to work on being fossil fuel free, there used to be another manager in the portfolio. We decided to stick with Westfield as they're a separate account. They continue to do well for the portfolio. and delivered positive returns in a negative market, which was nice to see. In terms of your global equity managers, I'm going to skip over Walter Scott just to say, they're now out of the portfolio. They did have a bad quarter, but focusing more on the other two managers, Impacts and Linsold Train, which I just went through from a due diligence perspective. One positive note was to see that Impacts did outperform during the quarter. So they had some information technology holdings and some exposure to semiconductors, which actually did well during the quarter. And even though they don't hold energy, they still were able to outperform. So nice performance on a relative basis from Impacts. And they also outperformed again in April, up 11.7% versus 10% for the benchmark. So nice results from Impacts, which is nice to see. Again, we'll be continuing to watch them and coming back at the next meeting with additional thoughts. The disappointing manager here is Linsold Train. Would expect in a time period where value is doing better that they would do better. But they underperformed 10% in the quarter, which is very disappointing. That has brought their long-term results down even further. They're already underperforming their benchmark on a long-term basis when we looked at this last quarter, and this quarter was no help. They don't hold any defense, banking, energy, or material stocks, all which did relatively well during the quarter. So again, looking very hard at Linsold Train given the due diligence announcements and the continued underperformance. Also note in April they underperformed again in a strong market environment. So this manager is been very disappointing. Silchester fossil fuel free strategy underperformed a little bit during the quarter. Long-term results underperforming, but we're looking at 1 and 3 years of very strong absolute returns. They tend to be a manager that should protect on the downside. It didn't happen during the recent quarter, but some of that is flowing through when markets are up pretty significantly. They will underperform. There's no concerns with this manager. Continues to be a strong strategy. And then Acadian, nice positive performance, adding value over the quarter. And then the long-term numbers falling a little short of the benchmark, but very strong absolute numbers and no concerns with this manager. Moving on to fixed income. Fixed income is usually a very bright spot of the portfolio in terms of manager value add. You can see that in the long-term numbers. If you look at the 3, 5, and 10-year numbers up here in the top, outperforming the Barclays aggregate. And this is due to having some outside of benchmark exposure. So things different than the Barclays aggregate, such as, BlackRock, which is more lower quality focused and very diversified credit type strategy. Things like Bain, which is bank loans, and even having some US tips in the portfolio. However, for the recent quarter, you can see that both BlackRock and Bain did underperform. A lot of this is due to the credit spreads widening in a difficult market for credit. No concerns with either of these managers, but just noting the difficult quarter as we saw equities down and credit spreads up. A couple positive areas of the portfolio on this page are both Newton and Lighthouse performing exactly how we would want them to perform during the recent quarter. You can see Newton up 2.7%, outperforming their benchmark, outperforming fixed income, outperforming equities. They have exposure to commodities and gold and other diversifying assets that really helped protect in this difficult quarter. And then with Lighthouse, again, you can see the positive performance here. What we expect from this manager is, in a difficult equity market, specifically the S&P 500, for them to deliver positive returns or returns above the S&P 500, which they have done so. And I would say that, both of these managers, looking at more of the intermediate time period, you can see that both of these managers are outperforming benchmarks. And then longer term, 5 years for Newton, 10 years for Lighthouse, both outperforming benchmarks. So no concerns with these managers, and nice to see them add value in a time when we really needed them to. Moving on to the pension, just noting one manager, well, I'll note two managers. Here's the iShares in the portfolio now. No returns because they were just incepted recently, so they don't have a full quarter. And then on the second page here, we have Principal, which is your real estate manager, which was another positive for the pension in addition to Newton and Lighthouse, adding some positive returns to the portfolio. And more recently, starting to come back after, if you look at the 3 years, was a difficult period for real estate, but the last 1 year or so has been a positive for Principal. We had reduced this allocation from about 8% to 3%. Given some of those difficulties that happened 3 years ago. And then lastly, with the operating fund, just want to note two managers here. The first one's Income Research and Management. You have them both for the Barclays aggregate mandate, but in this portfolio, you have them for a short-term government credit mandate. And if you look at the returns over all time periods, outperforming, ranking around median, they just continue to do what we want them to do, which is add a little bit value and just be that next level of liquidity outside of cash. And then down here at the bottom is PIMCO All Asset, another manager that delivered positive returns for the quarter, which was very helpful to the portfolio. They have similar things as Newton, but they do it in a different way. But the portfolio has exposure to commodities. They have exposure to REITs. Both did well during the quarter. And then they also do some type of liquid, what I'll call hedge fund-like type strategies, which also added value to their portfolio, delivering positive returns. So overall, the message is there's a lot of bright spots of the portfolio. The two areas that we're going to be looking at for next quarter is Lindsell Train and impacts, and coming to you with some deeper analysis and some of our thoughts on what the next best steps going forward with those managers are, as those really, in addition to Walter Scott, that's out of the portfolio now, that really has been the part of the portfolio for the pension and the managed investment pool that has been dragging down results. So with that, I'll stop and see if there's any questions. Okay. Thank you for your time. I'm going to flip over, if it's okay, Trustee Martin, to the next agenda item, which is the policy statement, and turn it over to Lauren.
Right ahead, thank you.
Great, thank you. So, as just part of governance and best practices, we do like to take an annual review of your policy statements to ensure that they are both current and aligned with our best thinking. So, Matt, Kelly, and I have reviewed the policy statements for all three portfolios. We do not have any recommended changes to the operating or the pension policies at this time. However, we do have several minor recommendations for the managed investment pool. These are intended primarily just to memorialize past decisions from the committee to ensure that that policy is capturing what your portfolio looks like today. So Kelly did review that the committee approved slight changes to the equity sub-asset class targets at the prior investment committee meeting. You can see those changes reflected in red line here under that target percentage column. You'll also see that the permissible ranges for those asset classes are redlined in the column to the right of that to ensure that those ranges are reflective of the new target. So to ensure that the ranges match what the policy percentage target is. Those are reflected in red line here and at one farther point down in that investment policy statement. The other change to this central table here is the benchmark used for private equity. And that's just a minor change from Cambridge to MSCI. And that's just reflective of NEPC updating our benchmark provider from Cambridge to MSCI. So that was a change made at NEPC, really just because MSCI has a more robust benchmark data set, and we want to ensure that your policy statement matches what you're seeing in your performance reports. The only other changes to be aware of here are date changes, again, to ensure that it's current, and a change to the footnote to capture a change made by UMaine to some management fees. And you'll see that again, just redlined in that first page in the footnote. But that really is the extent of the recommended changes to that managed investment pool policy statement. Can I take any questions to those red line changes on that policy statement? Great, thank you.
A quiet crew today. So that is an action item. So I'm going to read the text of the proposed resolution that the investment committee approves the updated investment policy statement for the managed investment pool. Do I have a motion? Moved by trustee McMahon. Can I have a second?
Second. Yep.
Second by trustee Baldacci. Thank you. Beth, I'll just hand it over to you to take the roll.
Yes, trustee Martin,
Yes?
trustee McMahon, trustee Baldacci. The motion carries.
Excellent, thank you. And I want to thank the NEPC team for a great review. Kelly, Matt, Lauren, always enjoy the partnership, your guidance and expertise. So thank you. Thank you for your presentations today. In this
Thank you
wild
so
market
much.
all over the place.
Thank you. It was great
Thank
to be
you.
with all of you. Appreciate all of you, and thanks for your time.
Happy start to the summer.
You too.
Thanks, Kelly.
Bye, everyone.
Thanks, everyone.
care.
Bye.
And let's see, I see Jen's on the phone from
I
Cap Trust.
am. I'm just texting Barry and Mike right now that they can feel free to join.
Excellent. Yeah, we're running about 20 minutes ahead of schedule. I think all of you will be pleased with that. Oh, I see Barry popping in and Mike popping in.
I see my camera's not on, Callie, so I'm going to just sign off and sign back on.
Okay, we'll
right.
wait for you.
All right.
Hello, Mike.
Hey, good afternoon, everyone.
Barry's practicing his retirement.
Yeah,
That's what's
I'm impressed he showed up at all, actually.
There we go, Barry. I just while you were gone, I was talking about you. I said you were practicing your retirement. So
Trying to.
Not
go ahead.
his
So-
retirement, not using Zoom.
That's right. That's right. So I was just going to pass everything over to Barry to announce his
Yep.
retirement, but I just let it slip out of the bag.
Yeah,
But
okay.
I wanted to say a few words before I pass it over to Barry to introduce Jen. But I just wanted to take this moment before we get into the defined contribution plan quarterly review to announce that Barry has announced his retirement. This is his last meeting, and you are living the dream that we're all working for. I couldn't be more happy for you, and I hope that you have an amazing retirement filled with health, happiness, friends, family, and enjoy. I
Yes.
also wanted to say that we've really enjoyed the partnership and the professionalism and the expertise. So this is a bittersweet day as you know we see you walk away to a happy place, and we're very excited to have Jen join the relationship. So I'm going to pass it on to you, Barry, to say a few words.
Yeah. Thank you for those kind words, Kelly. If you think about we have been on the University of Maine relationship since 2013, and think about kind of how we've morphed into what we have today over time. Obviously, it was a new frontier. We originally had 4 record keepers, now obviously 1 record keeper now. The fee discussion alone, we went from probably 10, 15 basis points in fees to where we're going to talk about fees today. So I've just been so honored to work with you, University of Maine relationship. It has been such a privilege to work with each of you. I just feel so good about the work we've done and the place we're leaving it. Mike's not going anywhere, but the place we're leaving it when I retire. So again, thank you for all your support over these last 13 years. It means a lot to me.
Does
The
anybody?
good.
Oh, go ahead.
I was just going to introduce Jen.
Okay, but before we introduce Jen, does anybody want to say a few parting words to Barry or congratulatory?
I can't let him leave without my personal thank you for all the help you've given over the years. It's been an extraordinary honor to work with you, and thanks for all of your assistance from the very beginning.
Thank you, Tracy. The good news is I am being replaced by a seasoned advisor, Jennifer Barker. So I'm gonna ask Jennifer to introduce herself to you. Then she's actually going to go into the quarterly review. So once she introduces herself to the committee, we'll pull up the screen and go through the first quarter review. So with that, Jen.
Great. Thanks, Barry. I recognize I have big shoes to fill, but terrific to meet all of you. I joined Cap Trust 5 years ago and came from TIAA. So I've got a lot of experience on the investment record keeping side, and incidentally also work with the public higher ed systems of Rhode Island, Massachusetts, and Vermont. So happy to add Maine to my personal client count. But yes, I'm going to lead the review today. Given that it's the first, if you have feedback, I'm sure my style is a little different than Mike and Barry, but always open to feedback, suggestions, etc., either directly or through Tracy and Kelly.
Excellent.
All righty, let's get going here. Presumably you can see the screen, the slides.
Yep.
All right, terrific. So this will follow kind of the usual routine of topics. We'll give some industry updates, do a brief market update, and then get into the portfolio. One of the reasons I joined early is I did want to hear NEPC because I don't want to duplicate market commentary that you've already heard. So I'm just going to call out a couple of those themes, more how they relate to the investments in the defined contribution plans. But we're getting off to a very easy start with this slide because we can ignore most of it. Left-hand side is for ERISA plans. But just a note on the bottom right, there have been a lot of regulations and new laws come out over the last few years. The CARES Act, the two Secure Acts, all need to be reflected in plan documents. And so there is a schedule of deadlines for restatements and updates. For governmental plans, we still have several years to do that. So more of an FYI, and I presume you use TIA's pre-approved documents, so they will prompt you when the time comes. The one thing I did want to spend a little time on is recent proposed regulation coming out of the Department of Labor called Fiduciary Duties in Selecting Designated Investment Alternatives, or DIAs. So this was prompted by the executive order last August, and that was called Democratizing Access to Alternative Assets in 401k plans. And I think the expectation was this proposed rule or regulation would be largely focused on alternatives, but it really wasn't. It was very broad. A DIA is any investment you offer in a defined contribution plan. And it didn't really do anything too novel, but what it did is reinforce the importance of due diligence process for fiduciaries. You know, the duty of prudence is a process-oriented obligation versus outcomes-oriented. And so what this rule or proposed rule is seeking to do is just reaffirm what a sound process involves. And kind of in that middle column here, if you're looking at the slide, you know, they list some factors that should be considered when selecting an investment. None of these are going to sound too novel to you: performance, fees, liquidity, etc. But it's not an exhaustive list. Obviously, fiduciaries have a lot of discretion over the different factors that can be considered, not just selecting, but in monitoring. So while this is not a statutory safe harbor, it does provide kind of a framework. And I think, you know, thinking about dipping a toe into alternatives, maybe considering target date strategies that embed some of these, and these are coming off the assembly line already from asset managers. This will help stave off what we think has kind of prohibited plan sponsors from adding these type of vehicles: litigation risk. So there's nothing you have to change in your process. You all are doing all of the right things. And incidentally, that executive order from last summer lists the type of alternatives that might be considered. It happens to include real estate and lifetime income options, two strategies that you already offer through your retirement plan. So, you know, I think there's not a lot to take away from this, except continue your sound process, keep abreast of developments in investment alternatives, and we obviously assist with that in discussions with you. But you know, I think this was very asset neutral, maybe more so than anyone expected. For any of you with an interest in ERISA litigation, these are just some stats from 2025. As a reminder, to date, there have been no lawsuits filed against non-ERISA plan sponsors for fiduciary breaches, but they do kind of continue unabated in the ERISA world. 94 altogether filed in 2025. Still excessive fees, underperforming investments, and forfeitures were the main areas of focus. But what we did see creep into these lawsuits was a new area of targeting stable value funds. And so if you think about the kind of the low interest rate environment that we had been in, and then rates started to come up again, what we saw is that money market fund yields started to surpass traditional stable value strategies, which do take a longer time to kind of catch up to prevailing rates. And so in some of these suits, it's like, hey, why didn't we have money market, which yielded more last year? We only had stable value. So I think, you know, from our standpoint, one thing to think about is to do a stable value review on a periodic basis, which I'm sure Barry and Mike have done in the past, but we'll make sure to include that in a future meeting. And then something sort of a tide changing, I would say, perhaps at the DOL with regard to amicus briefs. So amicus briefs are statements by kind of an outside party related to legal proceeding. And what this chart is showing is the gray bar is the total number of class action ERISA suits filed per year. The diamonds are the amicus briefs that were associated. If it's dark blue, it was pro participant, which is what we've kind of historically seen, but more recently, they've been filed in favor of fiduciaries. And I think a lot of that or some of that has to do with the new head of EBSA, the Employee Benefit Security Administration, Dan Aronowitz, Trump appointee. One of his goals is to kind of limit regulation by litigation. And incidentally, he founded a firm that underwrote fiduciary liability insurance policies. So professionally, he was on the wrong end of these settlements in filing claims. So you can kind of get a sense for where his point of view comes from. But the good news is we have seen increasing support for plan sponsors in some of these lawsuits. Noting that process is more important than outcome. Burden of proof, the plaintiffs can't simply just say these fees were too high, they have to show harm, things of that nature. So we definitely see some positive momentum here in some of these lawsuits. If you want to read more, here's some of the individual cases where amicus briefs have come into play. Any thoughts or questions there? All right, so you heard a lot about the first quarter. Obviously, challenging
Jen,
market.
you have a question.
Oh,
Question
I'm
from
sorry,
Jim Bradley.
Jim.
I'm
Yes.
sorry.
I'm
I
sorry.
was slow getting to my
Hand?
raised
Yes.
hand button there. So just and you might talk about this a little bit. I'm going back a few meetings, and we've talked on a couple occasions about the potential for adding collective investment trusts on 403(b) plans, and just curious as to whether there's been any movement on that, like congressionally or anything.
Sadly, no. And I think the expectation is that is probably not going to come to fruition this year. So it's still kind of anyone's guess when that finally gets approval. So it's a matter of amending some securities laws, and that's been the hang up. But once that finally does happen, and there's no reason why it shouldn't, that will definitely be a big topic of focus for us with you all.
Thanks.
Any other hands that I may have missed? All right. So you guys had a great overview earlier about the markets. I'll catch you up too, because things have definitely turned around in the second quarter. But a couple things to note: obviously, large cap U.S. equities down 4.3% for the quarter. So that was kind of the worst performing segment of the capital markets. Incidentally, the Vanguard Target Date series is slightly overweight U.S. equities, particularly in the shorter dated vintage. So that obviously is a detractor with that series for the quarter. But if we kind of look ahead, so far in the second quarter, if we go from right to left, just to bring everyone up to speed, emerging markets up 21.9%. Developed markets up 9.5%. S&P up just under 13%, small cap up almost 16%. So quite a reversal in the second quarter from where we were in the first quarter. Just a couple notes on this slide. Wanted to mention top right, yields were up slightly in the quarter. So if you look at 1 year and 10-year, 1 year went from 348 to 368. 10-year from 418 to 430. So that obviously, kept bond market sort of, flat for the quarter. The other thing, and Matt talked quite about this, is just the divergence in the winners and losers across equity markets. If you look at the best performing sector, which was energy at 38%, the worst was financials at -9. That's a 48% differential. That's the largest differential, the second largest differential in the last 20 years. And it wasn't all, negative returns. Bottom left is the style and capitalization quadrants of the U.S. equity market. And you see value did actually eke out positive performance and significantly outperformed growth. So that helps with some of the value-based strategies in the portfolio. Like to sort of end on somewhat of a positive note. We always include some headwinds and tailwinds, and the obvious headwind is the continued conflict in Iran. I kept checking news before this meeting because I guess we're awaiting some response from Iran on a proposed peace settlement, but that's a huge thing. And even if it resolves today, there is going to take some time to kind of work through some of the supply chain issues that have arisen. But there's still a lot of fiscal stimulus in the market. Tax refunds have been favorable. The U.S. is a lot more energy independent now than it was back in the 70s. And corporate earnings are still very strong. So even while we've seen valuations decline in some of those big tech names, there is still strong earnings to support overall, high, strong valuations and expected earnings. So let me get into the investments, which I'm sure that's what you're most curious about. So this just portrays the investment menu across all the different asset classes. You're well familiar with how we structure investment menus. We've got a target date series for those people who really want to outsource the selection and rebalancing activities to an investment manager. We've got a suite of low-cost index funds, and complemented by that is actively managed strategies across the different categories of the capital markets. From a plan asset standpoint, at the end of the quarter, across all plans, about $2.17 billion. Of that, about $361 million was invested in the target date series. Very popular, not unique to the University of Maine. We see that across our client menus. Incidentally, I checked, about 47% of plan contributions are directed towards those Vanguard target date series. So I always like to start the investment review with that. So let's get to scorecards. So the Vanguard target date retirement, scoring 93 at the end of March. As you all know, our scoring system is on a scale from 0 to 100, just like academics. So 93 is an A. That's a good mark. It had a solid quarter. Unfortunately, all vintages had negative returns, anywhere from about down 47 basis points to down 1.45 basis points. But they outperformed the benchmark that we monitor them against, and most outperformed the peer category. So the near dated, as I hinted at earlier, they lagged peers, again, because they have a slightly higher equity allocation. But the future dated or the longer dated strategies actually exceeded peers and it's slightly more conservative allocation versus the peer category. So that definitely helped with equity markets pulling back at that end of the curve. So no concerns there. I'll stay with kind of a good news story while we're on this page. The capital preservation strategies are still delivering very solid crediting rates and yields. So if participants got scared in the first quarter and gave into those jitters and moved out of equities and moved into capital preservation, wasn't a bad place to hide. The Vanguard Money Market Fund is 7-day yield is 3.58. And TIAA Traditional is crediting 5.25 in the retirement choice contract. So that's for the employer money, and 4.5 for employee money. So the liquid version. So still attractive rates in your capital preservation strategies. Now I would like to focus on the strategies that are marked for review. And those are the ones where we see the yellow triangle in the overall score. So I have some comments on the CREF responsible balance strategy, JP Morgan equity income, and Victory Sycamore established value. So CREF responsible balance, no change in score. It's been steady at 78. It actually had a strong quarter. It was down minus 1.55, but its composite benchmark was down 2%. So outperformed. The US equity sleeve outperformed, the fixed income sleeve outperformed, and non-US equity lagged, partially due to the underweight to energy. As a reminder, this is a 60-40 equity fixed income variable annuity. And while it is actively managed, the stated objective for this strategy is to deliver market returns over the long term, but doing so by favoring companies that score well along environmental, social, and governance criteria. And so when we look at since inception, the account has returned 8.14, the composite benchmark 8.28. So it has largely met its objective, although there are going to be time periods where, you know, excluding certain categories or certain names is going to be, you know, is going to have an impact on performance. But we saw a strong quarter, and if things kind of keep as they are, we'll hope to see that score improve, but not looking to replace or make any changes with that strategy. JP Morgan equity income, this is actually an improving story. The score has popped up to 79 from 70 last quarter. And I'm going to skip ahead to the fact sheet just because I think it gives you a better look at the fund, and also a trip down memory lane for why the score had gotten into kind of yellow category, yellow territory. So this is a very disciplined, defensive, large cap value strategy. It had pretty terrible results in 2023, down at the bottom of the peer category, trailed the benchmark by, you know, over 5%. And that was followed by kind of ho-hum 24 and 25. This quarter going into 2026, return 1.64 versus the benchmark at 210 did happen to exceed the peer category, so above median. When the strategy is below median for 3 and 5 years, that's when you see the score kind of dip into that yellow range. JP Morgan Equity Income Fund, you know, if we rewind to 2023, just to give you an idea, there were some names in the value index you might recognize, Meta and Netflix, names like that did not meet their investment criteria. They also have a fairly strict dividend policy. So, for example, Amazon has been added to the index, was added to the index in 2024. It's kind of a maturing business. No dividend. So it's not going to meet its criteria for inclusion. So a lot of those kind of misweights versus benchmark holdings were what drove the underperformance in the last few years, particularly when those names were outperforming the index overall. So we've kind of just seen some ho-humness over the last few years. And I think it would make sense, and there's a couple of others I'll throw in this category, to look at some comparative options next time we meet. And that might not lead to a change, but it's always a good exercise to see, you know, how other strategies are performing and whether having this defensive, you know, kind of disciplined option does fit in the overall portfolio. So we CapTrust still have a lot of confidence in the team. This broadening market is going to be helpful for a strategy like this. But nonetheless, as we kind of look over 135, it's, not really delivering on investment policy criteria. Over 10 years, it's above median. It's eked out some alpha versus the benchmark, but minimal. So I think not a bad quarter, not bad kind of medium term, long term, but might be worth a closer examination next time we meet, just to either kind of reinforce that this makes sense in the portfolio, or we might go in a different direction. While we're on the topic of value strategies, our other mid-cap value, this is one I'm going to put in the category of let's look at fund comps. We're going to have fund comparison palooza next time we meet. But the Victory Sycamore established value actually had a very strong first quarter in 2026, up 4.71 versus 3.68 for the benchmark, landed in the top quintile of the peer category, but also came off a pretty challenging 2025, which followed sort of mediocre 2023, 2024 performance. This is also, fundamentally based. They do prefer dividend paying companies. And it's particularly in mid and small cap, quality was out of favor and has been for several years now. So there has been this persistent headwind, coupled with some portfolio management changes and perhaps reaction to these changing markets that perhaps was not what we would have expected. This is definitely one that we are giving more focus, and I think would warrant some fund comparisons when we meet next. So great quarter, but it's coming off several challenging years. All right, Harbor Capital Appreciation, while we're here, this underperformed the benchmark in the quarter. If we look long term, this growth strategy has struggled to outperform the benchmark, but has managed, generally speaking, to be kind of at or above the median. Large cap growth, generally speaking, has been a challenging place to be with such a concentrated market in some of those Mag 7 names. So the Harbor Capital is the brand. Jennison is the underlying manager. They are, a well-known and well-respected growth manager. Not looking to make any changes, but definitely something that we want to keep on our radar. So in the first quarter, with kind of this rotation away from kind of AI related names and towards more defensive categories and names, the stocks that hurt it the most are the ones, are Microsofts, the Amazons, the Googles, the Nvidias, that type of thing. So those were the big detractors. What helped the portfolio, Costco, Merck, things like that, Walmart, the more defensive holdings in the portfolio. But definitely been kind of a challenging category for active management given the concentrated market, and we're not looking to make any changes here either. International, your international intrinsic value strategy. Just take a look here. Actually, we're not going to take. I noticed 5 minutes before this meeting, it's got the wrong benchmark. It outperformed EFA For the quarter, it was down 0.23, but EFA was down minus 1.24. So actually had a very good quarter. The only thing I wanted to note to you about international intrinsic value is they had a name change at the end of April. Now they're going to be called MFS International Intrinsic Equity. So not too dramatic a change, but the value is coming out of that, and it more aligns with kind of SEC rules over naming. It has to best reflect the underlying approach. So everything else is green except for those three that we talked about: Victory Sycamore, JP Morgan, and CREF Responsible Balance. The last one I want to mention is the real estate account. This is your other alternative. So it had a positive quarter, up 0.61%, bringing the 1-year number to 3.6%. So remember, this is commercial properties, direct holdings of commercial properties with a liquidity mechanism to accommodate participant daily trading. Suffered quite a bit when rates started to come up, but has really stabilized over the last 12, 18 months. I think the outlook is measured, but growing more positive for commercial real estate. But this is definitely one of those diversifiers uncorrelated to the other options in the menu. And incidentally has a pretty decent allocation of 50 million in plan assets, so 2.8% of the plan. And if you think about asset allocation tools, that, it's about right what they might allocate, or what those tools might allocate to direct properties. CREF Global Stock, right on benchmark, actually had a very good quarter. So in summary, and I know I went fast, but things look pretty good. We've got a couple of soft spots that I think we will address when we meet again by looking at some other alternatives in the category, particularly large cap value and mid cap value. But no recommended changes today, and definitely, hope the winds that have driven the market higher so far this year continue to blow in that direction. But let me stop and see if there are any comments or questions or anything you wanted to hear that perhaps I didn't touch upon. Mike P., anything to add?
Yeah, the only thing that I would say, and thanks, Jen, I thought that was a great job. The only thing that I would add is that if you added up all of the assets in the 3 funds that are marked for review that Jen talked about, we're talking about a little less than 5% of total plan assets. I think it's the nature of our quarterly reviews, as we do tend to spend our time on funds that are marked for review, maybe that had some performance hiccups. Again, that's just the nature of the review. But I guess I would say if you look at the overall state of the plan, where the vast majority of assets are sitting, things are not just in good standing, but frankly doing really well. I think 2025 was certainly an outstanding year. And if you look on a year to date so far in 2026, it's actually been a really good year as well. So just to kind of end the formal review piece on a positive note before we switch to the fee benchmark. And I think, Jen, I'll go ahead and share my screen for the fee benchmark if there are no other questions.
Thank you, Jen, for your presentation. It was great.
Welcome.
So let's see here. There we go. You can confirm that you can see that okay? Okay. Great. Well, again, it's great to see everyone. I'm going to keep this relatively brief, but also, stop me at any time if you have any questions at all about anything that I'm about to cover. This is our annual fee benchmark. So hopefully everyone on the committee knows, and maybe some of the new committee members, this might be the first time you see this, but we do a formal fee benchmark where we really break down the record keeping and administrative expenses and compare what University of Maine system is paying to market. And so that's what I'm going to go through. In addition to that, we feel like it's a good opportunity to just take a step back and look at the investment expenses as well. I always love doing that for the UMS plan because frankly, they're so incredibly low. So just to remind people really how strong the plan is from an expense perspective. The first several slides here that you reviewed, that you got in your meeting packets, really just goes through the fee benchmark process and really the importance of that process. Fees and expenses are a real focal point. You know, when Jen talked about her updates at the start of the meeting, you saw that, you know, we just continue to see a lot of litigation under ERISA. And while I know that your plan is not governed by ERISA, you folks follow ERISA as a best practice, and you're a large 403(b) plan. And so we just, you know, think that it's really important to continue to follow this prudent process of monitoring fees and expenses. So the first couple slides really just go through the importance of that. The slide that you're looking at now shows you the plan demographics that we used for the benchmarking purposes. And a couple things I did want to point out here. You know, Jen had mentioned earlier, $2.2 billion in total plan assets. That's obviously a really important figure. In addition to that, though, another really important figure is your average account balance, which is about $206,000. That's a really strong average account balance, just as a side note. The average 403(b) account balance at the start of 2025, this is overall national average, was about 109,000, almost 110,000. That's gone up quite a bit. So in 2026, it's about $130,000, but you know, $206,000 is a very strong average account balance, and it's a credit to the strong employee contributions, strong employer contributions, hopefully some really good guidance, you know, from advisors, and that's something you should be really proud of, not just the size of your plan, but the average account balance as well. The other thing that I did want to point out, though, is that TIA is record keeping 7 different contracts. That was something that was summarized in the earlier report as well. And I do think that that's something that's really important to note because, you know, the more contracts that they're record keeping, the more expensive it is for them to do that. It adds work. And so that's an important factor to take into consideration. In terms of how we break down the fees, I'm going to go through and show you the investment management fees by category and by fund. But then what we're really going to focus on today are the administrative expenses in the plan. And that's basically what TIA is charging participants for record keeping, administration, and the services that they're providing as well. But from an investment expense perspective, excuse me, you can see really low in terms of the overall investment expenses. We break your investments down in tiers. The first tier would be your allocation tier. That's your target date funds. The CRUF balanced account technically falls into that allocation tier as well. But if you look at the overall investment expense, predominantly of your target date funds, you can see 8 basis points is your total weighted average expense there. So really low. We think there's huge advantages to using index-based target date funds. The Vanguard series specifically, I would argue, is really as good, if not the best target date series on the market, certainly one of the best target date series on the market. And you're getting really good professional management in a low-cost index approach at 8 basis points. And that's about 18% of your overall plan assets. But again, I think more importantly, as Jen had pointed out, 47% of the money that's going into the plan is going into those target date funds. It makes that crucially important that you're in a high quality series. And I would argue that you're in the highest of quality series there. The next tier we break down is the standalone, or I should say, are the standalone target date funds. And you can see the weighted average here, 4 basis points, the most expensive being 13 basis points, the least expensive being your bond fund at about 3 basis points. So really low weighted average there. That's about 13% of your plan assets. And then we break down the actively managed funds. So obviously, actively managed funds are going to be more expensive. You have active managers that are actively researching, buying, and selling securities for the participants in your plan. So you can see the range there certainly is much more expensive than a typical index-based fund. But hopefully the active managers are adding value. The vast majority of your active managers are adding value. The weighted average there is 22 basis points. This is, I should point out, a little bit misleading, and I say that because TIAA we show as 0 in terms of the expense ratio. That's a spread product, so we don't really have an explicit expense ratio with that. But even with that, if you look at the overall expenses across your actively managed funds, really on the low end of the spectrum there as well. When you add that all up, your plan totals, your weighted average plan totals based on where the money is going is 11 basis points, but you do get some revenue credit. So you can see TIA Traditional, you're getting revenue credit back to the plan. The TIA Real Estate account, you're getting revenue credit back to the plan. So we back that revenue credit out, and that would bring in your total weighted plan average expense ratio at 9 basis points. So, frankly, anytime you have a weighted average expense ratio under 10 bips, it's certainly something that's very attractive, and I think a real strength of the program. Over here, though, you can see what we're really looking at today would be what are participants paying for record keeping and administration. And that number is $45 per participant. So we moved to a flat fee payment methodology a couple of years ago. That's one of those evolutions, I guess I would describe it, that Barry was talking about earlier. When we think back, 10 years of plan changes, I would argue that was one of the more impactful ones for participants. And the next page is where we then break that down. And the way that we do that is we show you how the University of Maine system record-keeping fees compared to other plans of similar size and similar average account balance. And that's something that's really important, not just the total assets, but the average account balance as well. This is basically, if your plan, we think if your plan were going out to bid today, these are similar to what you would be getting for bids. And so you can see the range that we have here, $39 per head on the low end to $45 per head on the high end. So with that, when you look at this range, we would argue that $45 per head, and we document that we believe that $45 per head is in the range of reasonableness when you compare it to other plans of similar size and similar average account balances. Especially, and I do want to emphasize, especially when you consider kind of the complexity that goes along with the record keeping of the University of Maine plan, because of those 7 different plans that TIA is record keeping. We don't know, I can't tell you specifically how many plans each one of these are record keeping, but 7 would certainly be on the high end in terms of the number of plans. All that said, we also feel like there's an opportunity to go back to TIA and maybe talk about that $45 per head and get a sense of, whether there might be some room for additional movement there. One of the dynamics at play is that we have had just a remarkable run up in the markets. And so if you look at your plan balance, it has gone up significantly. You may recall that we went to this $45 per head was only about 8 months ago. So we're certainly going back to TIA a little bit sooner than we typically would. But on the other hand, we have been in such an unusually strong market since we started that last round of negotiations with TIA. We think that it's at least worth having that conversation and seeing if there might be some additional room there. All that said, I want to emphasize from our perspective, when we look at the total package that you're getting from TIAA in terms of the record keeping, administration services, number of plans that are being record kept, we certainly think $45, is a reasonable figure, even if there might be, a little bit of room there for improvement. And so with that, I know that was a really quick overview, but I want to take a pause and see if there's any questions on anything going back to the investment expenses or the record keeping fees that you see on this page. So we're really, again, from a documentation perspective, we're certainly very comfortable as co-fiduciaries to the plan, stating that the plan is reasonably priced. But we, as I mentioned, we will be going back to TIA and having some additional conversations as well. And with that, I'm going to stop my screen share and just, I guess, see if there's any questions at all about anything going back to anything Jen covered or Barry covered. I'd be remiss if I didn't at least take a moment and also thank Barry. He has been just a great partner on this plan for me over the last 10 years, a really great friend outside of work as well. And when I think of Barry in the University of Maine system, I'll always remember him talking about doing the employee meetings up at the University of Maine, Fort Kent, after one of the hardest winters that we had in years. And he sent me a picture of him at the first mile mark, standing in front of about a 9-foot bank of snow. And Kelly, you'll appreciate this, still talks about his drive on Route 11 to this day.
Yeah. Oh, yeah.
Were
I'm
you
glad it was
greeted with
open.
some moose?
I did not see a moose. No,
No?
I was disappointed in that.
Well, thank you everyone for your attention today. That's all we have from CapTrust's perspective.
All right, I want to thank you, the crew over at CapTrust. We enjoy working with you. We appreciate your expertise and guidance, and thank you for the partnership. Jen, welcome. Thanks for the great presentation
Happy
today.
to be here. Yep.
We look forward to working with you, and Barry, good luck. Good luck. Enjoy. You earned it.
Thank you. Appreciate it.
Thanks, guys. Congratulations.
All right.
Thanks, everyone.
Bye-bye.
So that brings us to the end of the meeting, and I don't believe we have to vote, right? So we call it a meeting to we'll call it into the meeting and see some of you, most of you, hopefully in Fort Kent.